You are welcome to my channel today. If you are just coming across this YouTube channel for the first time, or if you have not subscribed in the past, please click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. Today I want to provide solution to ICANN November 2022 financial reporting question number 3 on group accounts. The question: Food PLC has a subsidiary, SBR Limited. The statements of financial position of the companies as at September 30, 2020 are presented below. We have the Food PLC and SBR Limited, amount in thousands. We have assets, non-current assets, 536,000 for food, and SBR 258,000. Investment in subsidiary at cost, 220,000 under food. We have current assets, which include inventories of 88,500 and 92,000 for food and SBR Limited respectively. Trade and other receivables of 75,400 and 69,800. Bills receivables of 30,000. Cash and bank 25,600 and 32,200. Due from SBR 20,000. We have the total assets. That of food is 995,500 and the total assets of SBR Limited is 452,000. We have equity and liabilities. Ordinary share capital 400,000 and 150,000 for food and SBR Limited respectively. Share premium of 50,000, that is for food. The retained earnings of 203,400 and 88,500 for food and SBR respectively. General reserves of 105,600 and 64,600 for food limited and SBR Limited respectively. Non-current liabilities, we have 10% loan notes, 100,000 and 50,000. Current liabilities, we have trade and other payables, 96,300 and 46,900. We have bank overdrafts, 40,200 and nil. We have bills payables, nil and 40,000. We have due to Food PLC, nil and 12,000. Total equity and liabilities 995,500 and 452,000 for food limited, food PLC and SBR Limited respectively. Now we have additional information. 1. Food PLC acquired 480 million shares in SBR Limited 2 years ago, when the balances in the retained earnings and general reserves were 60 million and 48 million naira respectively. 2. The fair value of non-controlling interest in SBR Limited as at the acquisition date was 158 million naira. 3. During the year, goods costing 80 million naira to Food PLC were transferred to SBR Limited. It is the policy of Food PLC to transfer goods at cost plus 25%. A quarter of these goods have been sold by SBR Limited at year end. 4. Part of the bills receivables have been discounted by Food PLC. 5. The sum of 8 million naira transferred by SBR Limited to Food PLC as per payment for indebtedness was received after the reporting date. 6. An impairment test revealed a loss of 60 million naira on the goodwill arising on the acquisition of SBR Limited. 7. The carrying amount of the net assets of SBR Limited is 20 million naira, more than the fair value at acquisition date. This was due to loss in value of company's machinery occasioned by change in technology. The machinery is depreciated at a flat rate of 15% on cost. Eight, the nominal value of the ordinary shares of Food PLC are denominated in 50 kobo per share, while those of Eba Limited are 25 kobo each required. A. Prepare the consolidated statement of financial position of Food PLC Group as at September 30, 2020. Again, on bargain purchase may arise in the course of a business combination, and when this happens, the acquirer must review or reassess the procedure used to measure certain items at the acquisition date. B. Explain the time gain on bargain purchase and identify the 3 items stipulated in IFRS 3 that must be reviewed. That is the question. This question is obtained from ICANN November 2022 financial reporting question number 3. Now let's have the solution. The first thing, we want to draw the group structure. But before we can draw the group structure, we must have determined the percentage of acquisition. Percentage of acquisition. In my previous video, I've told you that to calculate the percentage of acquisition, you use the number of shares acquired by the parent company from subsidiary over total number of shares of subsidiary. So, now how many shares were acquired by the parent? Food PLC acquired 480 million shares. The number of shares acquired is 480 million. Over what is the total number of shares of the subsidiary? Back to the equity section of the statement of financial position. Ordinary share capital 150 million. So now we have over 150 million divided by the par value of the subsidiary's share. What is the par value of the subsidiary share? Back to note 8. The nominal value of the ordinary shares of Food PLC are denominated in 50 kobo per share, while those of Eba Limited are 25 kobo. The par value is the same as the nominal value. So the par value of subsidiary share is 25 kobo divided by 25 kobo, 0.25 times 100. Therefore, percentage of acquisition equals to 480 million divided by 600 million times 100. That gives us 80%. So this one, if you have 150 million divided by 0.25, that will give us 600 million. That is how I got 480 million over 600 million. So you have the percentage of acquisition, you have it to be 80%. The next thing is the group structure. Group structure. The name of the parent is Food PLC. Food PLC acquires 80% of subsidiary, and the name of subsidiary is Eba Limited. So that means NCI will be 20%. So the parent stake in the subsidiary is 80%. The percentage attributable to non-controlling interest will be 20%. Now, having drawn the group structure, the next thing, let's have the summary of subsidiary net asset. Working 1. Summary of the name of the subsidiary is Eba Limited. Net assets. I've told you that net asset, if you have watched my earlier presentations, I've told you that net assets are equity. So that means you go through the equity section. What are the components of equity? The components of equity include ordinary share capital. Then subsidiary has no share premium. We have ordinary share capital, retained earnings, and general reserves. So let's have date of consolidation, date of acquisition, post acquisition. Since the reserves is divided into two, we have retained earnings, and we also have general reserves. The post-acquisition section, post-acquisition, you divide it into retained earnings and general reserves. The date of acquisition, DOA, all amount in thousand. So the equity, we have ordinary share capital, we have retained earnings, and we also have general reserves. Now, the ordinary share capital of subsidiary is 150,000. The retained earnings is 88,500, and general reserves is 64,600. 150,000, 88,500, and 64,600. So 150,000. The retained earnings is 88,500, and the general reserves is 64,600. Your ordinary shares at DOE will still be 150,000. You cannot have ordinary shares in the retained post-acquisition retained earnings, and neither will you have it in general reserves. Then retained earnings. How much is the retained earnings of the subsidiary at the date of acquisition? Back to the note. Food PLC acquired 480 million shares in EBA Limited 2 years ago. Acquisition was in 2 years ago, when the balance in retained earnings and general reserves were 60 million. That means retained earnings is 60 million, general reserves 48 million at the DOA. So retained earnings 60 million, general reserves 48 million at the date of acquisition. Therefore, post-acquisition retained earnings will be 88,500 minus 60,000. That will be 28,500. 28,500. That is the post-acquisition retained earnings. Then the general reserves, 64,600 minus 48,000. That gives us 16,600. Post-acquisition general reserve is 16,600. Now, let's go through the note. Note 2. The fair value of non-controlling interest in EBA Limited as at the acquisition date was 158 million. This is the fair value of non-controlling interest. 3. During the year, goods costing 80 million to Food PLC were transferred to EBA Limited. This is an intergroup trading. The Food PLC sold goods to EBA Limited. The seller is Food PLC. Remember, I've told you that the double entry treatment for the unrealized profit that will be calculated on the unsold items of inventory is to credit the consolidated inventory and debit the retained earnings of the seller. The seller in this case is the Food PLC. We are going to deduct it from the retained earnings of Food PLC. Remember, the summary of net asset we are calculating here is the summary of the net asset of the subsidiary. Since parent is the seller, we don't have anything to do with that. But this subsidiary is the seller. That means the unrealized profit will be calculated and be deducted from the post-acquisition retained earnings of the subsidiary. So, since parent is the seller, we ignore that. A quarter of these goods have been sold by EBA Limited at the year end. So we don't need that for now. Note 4. Part of the bills receivables have been discounted by full PLC. I've explained the intergroup trading. I've told you that, intergroup receivables. I said intergroup receivables will be eliminated. But in this case, the intergroup receivable will be eliminated. But you have been told part of it have been discounted. I've told you that the portion of the intergroup receivables that have been discounted is a liability to the third party. Since it is a liability to the third party, the portion that have been discounted will be consolidated, while the undiscounted portion will be eliminated. So that is when we get to consolidation, the undiscounted portion will be eliminated, while the portion that have been discounted will be consolidated. Note 5. The sum of 8 million transferred by EBA Limited to full PLC as per payment for indebtedness was received after the reporting date. This is cash in transit, cash payment. Payment has been made. It have not been received after the reporting date. That is cash in transit. I told you that cash in transit should be added to the consolidated cash or bank. So let's leave that. 6. An impairment test revealed a loss of 16 million naira on the goodwill arising on the acquisition of EBA Limited. This is an impairment test. Since the policy is fair value, I've told you that where the policy is fair value, that the impairment loss should be deducted from the subsidiary retained earnings. But where the policy, the group policy, is proportionate, you deduct the impairment loss from the retained earnings of the parent. So in this case, the policy is fair value. Therefore, we are going to deduct the impairment loss on goodwill of 16 million from the retained earnings of the subsidiary. So let's have the impairment loss. Impairment loss. This column, DOC, is just a memorandum column. That is not our focus. It just, the amount here, this column shows, it shows the total of the item that will be transferred to DOA or post-acquisition. So by including it here, it is immaterial. So what we are concerned with is its treatment, which will appear in the post-acquisition retained earnings. The reason for treating it in the post-acquisition is that the impairment loss that occur as at the DOA, date of acquisition, will relate to the post-acquisition period. That means it is the loss occur at the DOA and it will continue towards the end, till the year end. It's not a loss that have occurred prior to acquisition by the parent. So you treat it in the post-acquisition period. Now, after the impairment loss, note 7. The carrying amount of net assets of EBA Limited is 20 million more than the fair value. The carrying amount is more than the fair value. More than the fair value at acquisition date. If the carrying amount is more than the fair value, that means there is a fair value deficit. So we have fair value deficit. Fair value deficit of 20 million. When does it occur? The carrying amount of net asset of EBA Limited is 20 million more than the fair value at acquisition date. It occurs at the date of acquisition, therefore you put it in date of acquisition, which is DOA, 20 million. Fair value deficit. Now, what type of asset is being fair valued? We want to know whether it is a depreciable asset or not. We were told this was due to loss in value of company's machinery occasioned by change in technology. The machinery is depreciated at flat rate of 15% on cost. So, when was the acquisition took place? The subsidiary was acquired when? Full PLC acquired 480 million shares in EBA Limited 2 years ago. Acquisition is 2 years ago. That means you are going to calculate excess depreciation or over depreciation. Excess or over depreciation. You know this fair value is attributable to machinery. So resulting in the over depreciation, and the depreciation rate is 15% of 20 million, and for 2 years ago, since acquisition took place 2 years ago. So 15% of 20,000 times 2. Acquisition is 2 years ago, so we have 6,000. We add excess depreciation back. So 6,000. We add it to the profit. So post-acquisition profit. Now, after all this adjustment, what is now the balance? So we have ordinary shares. No, you are dealing with summary of EBA limited net asset. The total of this column is 273,100. Then this column 150,000 plus 60,000, that is 210. 210,000 plus 48,000, that is 258,000. 258,000 minus 20,000, you have 238,000. Then the retained earnings, we have 28,500 minus 16,000 plus 6,000, that is totaled 18,500. Then we also have the general reserves. You have post acquisition of 16,600. Now let's start the consolidation. The name of the parent is Food PLC. So you have Food PLC Group. Consolidated statement of financial position as at September 30, 2020. You have assets. Number one asset is non-current assets. Non-current assets. Let me have that as working 2. So, working 2. Non-current assets. You have that of the parent, Food PLC, that of the subsidiary, EBA Limited. The non-current assets of Food PLC is 536,000, while that of EBA Limited is 258,000. So we have 536,000 and 258,000. And you were told in note 7 that the carrying amount of net asset of EBA Limited is 20 million more than the fair value. There is a fair value deficit. Fair value deficit attributable to machinery of 20 million. Fair value deficit, you subtract that, then resulting in excess depreciation of 20,000, 15% of that. You know, depreciation rate is 15%. From date of acquisition to date of consolidation, which is 2 years ago, giving us 6,000. So, what is the total? 536,000 plus 258,000 minus 20,000 plus 6,000. Then you have 780,000. So our non-current asset is totaled 780,000. Then we have acquisition of SBR Limited. You need to calculate the goodwill on acquisition of SBR Limited. Let me have working 3. Acquisition of SBR Limited. You want to calculate goodwill on acquisition of SBR Limited. You know, goodwill, we have consideration transferred, consideration transferred. The consideration transferred is 220 million. Investment in subsidiary at cost. We have 220 million. 220 million. Then back to the note 2. The fair value of non-controlling interest in SBR Limited as at the date of acquisition was 158 million. So we have fair value of NCI at acquisition, and that amounted to 158 million. So when you add 378 million, now let's fair value of net asset. Fair value of net asset at the date of acquisition, and this is obtained from the summary of our net assets, summary of net assets, and the fair value of net asset under DOA, and that amounted to 238,000. So we have 238,000. So when you subtract 238,000 from 378,000, then we have 140,000. And you were told from note 6 or in note 6 that an impairment test revealed a loss of 60 million on the goodwill arising on acquisition of SBR Limited. So we have impairment loss. Impairment loss of 16 million. By the time you subtract the 16 million from 140 million, you have 124 million. That means goodwill on acquisition of SBR. That amounted to 124 million. Working 3. We have the goodwill to be 124 million. So, if you sum it up, total you have the total of our total of our non-current assets. So we have 124 million plus 780 million. That is total 904 million. After non-current assets, we have current assets. Current assets. So current assets include, number 1, we have inventories. Our inventories, we have inventories, that is working for. Inventories. Working for. Let me have it here. Working for. We have inventories. We have the parent, which is Food PLC. We have the subsidiary, which is SBR Limited. Inventories of Food PLC amounted to 88,500. while that of EBA Limited amounted to 92,000. So we have 88,500, 88,500 and 92,000. Back to the note. During the year, goods costing 80 million to Food PLC were transferred to EBA Limited. The cost to the seller is this. This is not the invoice price. Therefore, you are going to mark it up. It is the policy of Food PLC to transfer goods at cost plus 25%. Therefore, you calculate the unrealized profit. Provision for unrealized profit, which will be 25% of 80 million. This should be 25 over 100, not 25 over 125, because it is not the invoice price. The 80 million given in the question is the cost and not the invoice price. Therefore, 25% of 80 million gives us 20 million. That is the unrealized profit. Sorry. Not all the items are still in the inventory. Let's proceed. A quarter of these goods have been sold by EBA Limited. A quarter, 1/4 have been sold. That means 3/4 will still be in the inventory. So we have times 3/4. Times 3 divided by 4. That gives us 15 million. That is the unrealized profit. So you remove it. So we have 88,500 plus 92,000 minus 15,000. That gives us 165,500. That is the inventory. So our inventories now, under current assets, we have inventories of 165,500. That is from working for. After inventories, we have trade and other receivables. Trade and other receivables. There is no note attached to that, so we add it directly. 75,400 plus 69,800. 75,400 plus 69,800. That is totaled 145,200. After trade and other receivables, we have bills receivables. Bills receivables, 30 million. If you check your current liabilities, you have bills payables of 40 million. Bills payables, 40 million. Bills payables, 40 million. And under current asset, we have bills receivables of 30 million. Then in the note, you were told, note 4, part of the bills receivable have been discounted. That means the reason why the 30 million fails to agree with the 40 million you have as bills payables is because of the 10,000 that have been discounted. So that means you cancel the 30 million against the 40 million. Then you now be left with 10 million. That is the amount discounted. Intergroup receivable will not be consolidated. It should be eliminated. Therefore, that should be eliminated. After bills receivables, we have cash and bank. Cash and bank. I've told you that intergroup receivables will be eliminated. We have 25,600, 25,600 plus 32,200, 32,200. Then in the note, the sum of 8 million transferred by EBA Limited to Food PLC as per payment for indebtedness was received after the reporting date. I've told you that there is a cash in transit of 8 million. Cash in transit, you add it to cash and bank, plus 8 million. So we have 25,600 plus 32,200 plus 8,000. That is total 65,800. Then we also have due from EBA, 20 million. Then under current liabilities, we have due to Food PLC, 12 million. If you look at the 12 million you have here as due to Food PLC, 12 million, it does not agree with due from EBA or 20 million. The difference between 20 million and 12 million is the cash in transit which we have added here. So that means this will be cancelled against this. We only consolidate the cash in transit. If we sum up the assets, we have 904,000 plus 165,500 plus 145,200 plus 65,800. The total of all the assets is 1,280,500. That is total assets. Total assets. After the total assets, the next thing is equity and liabilities. Equity and liabilities. As part of the equity, we have ordinary share capital. Ordinary share capital, 400,000, parent only. Ordinary share capital of 400,000, that of the parent, 400,000. Parent also have share premium. We have share premium of 50,000 naira. 50,000. After share premium, we have retained earnings. Retained earnings. Let's have working 5. Working 5. Retained earnings. So we start with the parent retained earnings, which is Food PLC. Food PLC retained earnings as per statement of financial position. The retained earnings of Food PLC as per statement of financial position is 203,400. 203,400. 203,400. We also have parent share, that is Food PLC. Share of adjusted post acquisition retained earnings of EBA Limited. No, the parent stake in EBA Limited is 80%. You have 80% of post-acquisition retained earnings of EBA Limited, which is 18,500. 18,500. 80% of 18,500. And that is totaled 14,800. Now let's go through the note. Note 3. During the year, goods costing 80 million to Food PLC were transferred to EBA Limited. It is the policy of Food PLC to transfer goods at cost plus 25%. A quarter of these goods have been sold by EBA Limited at the year end. The seller is Food PLC. Parent is the seller. So you will need to calculate the unrealized profit on the unsold item of inventory. Provision for unrealized profit on unsold inventory, on unsold inventory. Note markup is 25%, 25 over 100. I have told you that it will not be 25 over 125. The reason is that the 80 million is the cost to put PSE, not the transferred price. This 80 million is not the invoice price or the transfer price. It is the amount it costs the food PSE. If this were the transfer price of the item sold, that is the selling price or the invoice price, it would have been 25 over 125. But since this is the cost, so we have 25 over 100. And only one third have been, a quarter of these goods have been sold. That means 3/4 are still in the inventory. So we have 25% of 80 million times 3/4. 3/4 are in inventory. 25% of 80 million times 3 divided by 4, then the unrealized profit is 15 million. Now, note 4 is intergroup bills receivable. That is bills receivable. That is bills of exchange. The sum of 8 million transferred by SBR Limited to full PSE as part payment. This is cash in transit. So, these are the items that affect the retained earnings, which are yet to be considered. Remember, the policy is fair value. Is fair valued, and our impairment loss have been adjusted in the retained earnings of the subsidiary. That means parent shares have been embedded in the summary of the net asset. So we don't need to deduct the realized profit here again. But if you did not include it here, you are going to calculate 80% of the 60 million to get the parent share of the unrealized profit. Same is the excess depreciation. So it will also be calculated that way. But having adjusted it, since it has been adjusted in the summary of the net asset, so you don't need to share between the parent and NCI, since the adjusted post-acquisition profit have been shared between parent and NCI. So now, what is the total? 203,400 plus 14,800 minus 15,000. You have 203,200. 203,200. That is the retained earnings of the parent. So we have retained earnings. That is from working 5. And that is 203,200. After retained earnings, the next item is general reserves. General reserves, let's add that as working 6. General reserves. Working 6. So now, working 6 now. Working 6. General reserves. So you start with the general reserves of the parent, full PSE general reserves as per statement of financial position, which is 105,600. Food PSE general reserves as per statement of financial position, which is 105,600. 105,600. Now have food PSE. PSE share of SBR Limited. General post acquisition general reserve. Post acquisition general reserves. The stake of food PLC is 80%. That is the stake of food PLC in EBA Limited. And the post-acquisition general reserves of EBA Limited is 16,600 times 16,600. 80% of 16,600, that gives us 13,280. 13,280. By the time you sum up 105,600 and 13,280, the consolidated general reserve is 118,880. 880. That is the amount that will be consolidated. 118,880. 118,880. So you sum up the equity attributable to the parent plus 203, 200 plus 50,000 plus 400,000. So you have 772,080. That is the equity attributable to the parent. Then the next item is non-controlling interest. Non-controlling interest. Let's have that as working 7. Now, working 7. Working 7. Non-controlling interest. We have food PLC. We have fair value of non-controlling interest. Fair value of non-controlling interest at acquisition date. Back to the note. Note 2. You were told that the fair value of non-controlling interest in EBA Limited as at the acquisition date was 158 million naira. The fair value of NCI is 158 million. Now have NCI share of adjusted post acquisition. Adjusted post acquisition retained earnings. If the parent stake in subsidiary, if it is 80%, then the stake attributable to NCI will be 20%. 20% of the post-acquisition retained earnings of EBA Limited is 18,500. Let's calculate 20% of 18,500. 20% of 18,500. 18,500. 20% of that. That is, it will give us 3,700. Same thing for general reserves. General reserves. 20% of general reserves. The general reserve post acquisition. General reserves 16,600. 20% of 16,600. That gives us 3,320. So you now sum it up. Plus 37 plus 158,000. Our NCI is totaled 165,020. 165,020. 165,020. So when you add it to 772,080, the total equity is 937,100. 937,100. That is total equity. After total equity, the next item is non-current liabilities. Non-current liabilities. It includes 10% loan notes. 10% loan notes. That of food PSC is 100,000. That of EBA PSC is 50,000. The total will be 150,000. After non-current liability, the next item is current liability. Current liability. Our current liabilities include trade and other payables. Trade and other payables. We have parent 96,300. That of subsidiary is 46,900. By the time you sum it up, 96,300 plus 46,900, that is totaled 143,200. Then we also have bank overdrafts. Bank overdrafts. Bank overdrafts. We have 40,200. 40,200. The cash in transit, which have been added, that 8 million, which have been added to cash and bank here. If you don't want to add it to cash and bank, you can deduct it from bank overdraft. That means the bank overdraft will now be left with 32,200. So that means the total here will reduce by 8 million. That is if you have chosen to treat it as part of the as a reduction in bank overdraft. After bank overdraft, the next item is bills payables. Bills payables. Bills payables. I've told you that only 10,000 have been discounted. So, where there is interbills receivables, I said interbills receivables will be eliminated. And where portion of it, or where bills receivable have been discounted, that means bills receivable discounted is a liability to the third party, and that will be consolidated out accordingly. But the undiscounted portion should be eliminated. So, I've told you that 30,000 have been discounted. That is why 30,000 have not been discounted. Only 10,000 have been discounted. It is the 10,000 that have been discounted that will be consolidated. That is why if you check your current asset, you will see 30,000 there. That is when I told you that the 30,000 will be cancelled. Then you'll be left with 10,000 in these payables here. So the 10,000 that have been discounted is what will be consolidated. Then we also have due to food PSC, 12,000. I told you that this has been cancelled against the 20,000. Why the difference between the 20,000 and this 12,000 is the cash in transit, which we have added to the cash and bank of 8,000. So in that case, this due to food PSC will be eliminated as well. So now you can total everything now, equity and liability. 937,100, 937,100 plus 150,000 plus 143,200 plus 40,200 plus 10,000. That is total 1,280,500. That is total equity and liabilities. I've told you that total equity and liabilities must agree with the total asset. Our total asset is 1,280,500, and the total equity and liability is also 1,280,500. Both are the same. That is the requirement A. Now, let's take requirement B. A gain on bargain purchase may arise in the course of a business combination, and when this happens, the acquirer must review or reassess the procedure used to measure certain items at the acquisition date. B. Explain the term gain on bargain purchase and identify the 3 items stipulated in IFRS 3 that must be reviewed. A gain on bargain purchase is a business combination in which the calculation of goodwill leads to a negative figure. A business combination in which the calculation of goodwill leads to a negative figure. Gain on bargain purchase is a business combination in which the calculation of goodwill leads to a negative figures. You are also asked to explain, identify the 3 items stipulated in IFRS 3 that must be reviewed. The acquirer must review the procedure used to measure the following items. They must review the procedures used to measure the following items. Number 1, we have the identifiable assets acquired and liability assumed. Number 1, the identifiable assets acquired and liabilities assumed. 2, they must review the procedures used to measure the non-controlling interest in the acquiree. Review the procedure used to measure the non-controlling interest in the acquiree. Number 3, they must also review the consideration transferred. They must review the consideration transferred. You know, these are the 3 items used to calculate goodwill. You know, when you are calculating goodwill, you have consideration transfer plus non-controlling interest less the fair value of the identifiable net assets at the date of acquisition. This is the end of my solution to this question. Watch out for my next presentation. Please, if you have not subscribed, please don't forget to like, share, and subscribe. Thanks for watching Ezikan.